All right, here we go. So this lecture is going to be on the historic price action of Bitcoin. So if you look out, I'm using the Bitstamp on TradingView. It's not the most, it doesn't have the complete price history, but it has a good enough. It starts all the way at I think it starts at 2011. So August 2011, all the way to our current time, we have the Bitcoin price action. And I think if you are a trader, a true trader, you really want to take as much historical data as you can and use that as reference points to plan your trades, understand why the market is moving the way it's moving, etc., etc. So I'm on the weekly chart. And you don't really see much of the price. We don't really talk much of the price action between 2011 and 2017, but I think there are some very significant events, and these significant events can help you navigate the current price action in the markets. And then I'll also share some ideas about the next possible crypto cycle and how to think about the Bitcoin narrative. And then on my second screen, you won't be able to see it, but I do have sort of the price history of Bitcoin, so I'll talk a little bit about some relevant events that could affect the price and change. And that will be really important too, because certain dislocations in the market cause extremely profitable opportunities that you can take advantage of if you know when to plan for them, and if you read the history and say, like, yeah, that's something like that. So I'm just gonna jump right in. You can see the chart. I mean, like, you really have to kind of like go in. But I mean, imagine it's like, imagine buying Bitcoin at $80 or something like that. Like, it'd be ridiculous to be a millionaire. Like, there's just a lot. I'm always astounded by it too, and especially looking at the earlier cycles too. Like, I have to really go into that just to get that. Okay, so where we're gonna start? Let me go look on the price history. I mean, even in 2010, I think the starting price was 0.003 cents, and it ended up at like 30 cents, which was a 9,900% increase. I mean, whoa! So we're really early. If you do think about, if you're like a long term, you think the blockchain is going to be around for the rest of your life. Like, I don't think that you are at lack of opportunity. I think that there's so much interesting things, and I like to apply these older charts to the regular one. So not much to say about this. You can see here where you have that very nice, accumulation. Then you have this uptrend, and then at the uptrend, you have that like kind of euphoria, and then it sells off. Let's say, how much does it sell off? Like 80%. So like 80% corrections can be very normal. But one pattern that I really think I use and apply to altcoins is the simple like parabolic auction. And also, this is the time when there was no derivatives, right? So it's really just either buy or you don't buy, similar to like Pepe. And when I look at certain patterns here, you can see this kind of like 45-degree angle curve. Then it shifts up to like a steeper curve, and then it just shoots up like a moon, and then it just crashes, right? Like, and that's sort of the parabolic auction that's very common in most of these crypto coin assets. It's really worth paying attention to, because you basically then you have a range high, then you have a range low created by this, and then there's your trading range, right? So I think this even works really nice with the fibs. So even, let's say you start really close here and here, like, okay, we take this wick, and then you back test all the way down to like the 618 Fibonacci. and that becomes an accumulation, and then we actually retest it here and then it just goes and does another auction, and then you have like another auction in December. So what can I see on the price chart? That's what can I see on the history? So I'm gonna read some history from this era. In 2009, that's like the Genesis block. It's the famous text and note headline from London Times: Chancellor on the brink of second bailout for banks. So this is the 2008 financial crisis. Yeah, so that really is part of the history of Bitcoin, is something that arose from the 2008, 2009 financial crisis. It rose from a response to it, and in 2008 financial crisis, when I go through the Euro University, basically it's a collateral crisis, right? So we have a Eurodollar system, which is offshore U.S. dollars or dollars that are not created or controlled by the Federal Reserve, and they're used to settle dollar-denominated debt, right? Like the petrodollar or stuff in euro. So it's not like a euro. It's like actual dollars outside the United States, and they're used to settle asset liabilities that are denominated in a dollar. And it's a really big system, and the collateral for that system is U.S. Treasuries. And so when there's like a treasury squeeze or a treasury shortage, that puts pressure on people who need to pay the liabilities off in that system. And then that's kind of where you get your first round of quantitative easing. So quantitative easing is when the Federal Reserve, they print this thing called reserves, which are banking money, and then they swap it for treasuries, and they use that to kind of bring down the interest rate. So it's basically, you have like quantitative easing, which is central bank buys reserves, they swap it for treasuries, they use that to bring interest rates down, and then people feel like, okay, well, we can lend and we can roll over our debt constantly because the interest rates are so low, and that creates this boom in credit, and then all that credit is spent on speculation, and then you get, Bitcoin, which is sort of the tail end of this speculation, because when interest rates are low, companies don't have to really pay off their debt. They can keep rolling it over and over and over again. And that means you sort of get these zombie companies that don't really have to be profitable. They just have to be able to get more debt. And when interest rates, of course, tighten, the reverse happens. It's like, okay, well, we need to sell our debt, and we need collateral to settle our debt, which would be treasuries. And so that's kind of more a very small summary about the relationship between U.S. treasuries and the Eurodollar and quantitative easing. I mean, I think if most of you study a little bit of the central banks and how they work, we know, because we're in a tightening cycle right now, and that's having a lot of effects too. And one thing I might be curious of is if there's debt that's just used to buy Bitcoin, or credit used to buy Bitcoin, and then that needs to be paid off, and will that be, will they have to actually sell off their Bitcoin assets in order to pay off the loans now that the interest rates are higher? We don't know. That's something possibly in the Tether world, but I won't really go into that. The main thing I want to return to is that Bitcoin started 2009, really after the great financial crisis, which is what I was talking about. And by great financial crisis, I also mean the housing bubble. But the housing bubble kind of relates to that, because everybody's on debt, and when we're on debt, really low interest rates means that we can keep this Ponzi scheme going. The other thing is, in 2009, the European sovereign debt crisis. It began in November, when Greece revealed to have a budget deficit that nearly doubled prior to estimates. And this doesn't really affect Bitcoin's price, but it's when we're having cracks in this monetary system, that's really interesting. So let's see. I'm going through the Bitcoin magazine. There's a little interesting tidbit of 2009 number of Bitcoin Talk traded 5,050 BTC for the sum of $5.02 on PayPal. So that's crazy. And but actually in 2010 is when Bitcoin really started to trade. And of course we have 160 BTC sold for like 0.003, but then we rally all the way up to 0.30. And on May 22nd, Laszlo Hangyek bought 2 pizzas for the price of 10,000 Bitcoin. So the most regretful trade, I hate my life type of trade. But it was the Bitcoin pizza. So there you go. And then on July 18th, you have the first large-scale Bitcoin exchange, Mt. Gox, which we talk about a lot these days because it gets hacked, and then someone stole the Bitcoin, and now they have to dump these Bitcoin on the market. So that's kind of my look on that. In 2011, you had dollar parity, which I think when it was trading actually at the dollar, so that's pretty significant too. I mean, really, you really just go look at this, and it's like a phenomenally just up only chart. Like if you just bought Bitcoin, you just like bought it as like a little like collector's card, it would make a lot of money. But there's so in 2011, Mt. Gox actually experienced its first hack. 2012, we have the European debt crisis, where European sovereign debt was highly dependent on the European Central Bank and International Monetary Fund to service their debt. Cyprus was really hard hit, and there was, I guess, some demand for Bitcoin during that, but I'm not really sure. 2012, we had the start of Coinbase. So Coinbase is actually a pretty old OG. And let's see, 2013, we had a Silk Road seizure too, but we had a really huge uptrend over there. And okay. And in 2014, Mt. Gox is hacked. So I think that's actually the time around here when Mt. Gox was hacked. And okay, so that's the price action. That's like the most significant events. In this major period, you have European debt crisis and then this rise of Bitcoin. So, I mean, that's something to be positive if you were to take a reflection of we're going through a recession, we're going through a crisis. And a lot of these blockchain technologies arise in response to crisis, right? Like the reason that a lot of people want to invest in them is because they're frustrated with their institutions, they're frustrated with their government and the monetary system and inflation, and they're looking for alternative solutions. And that when you're buying these things that can go literally 20, 30x on your money, you're sort of betting on, in my opinion, on fundamental analysis, because I don't really see them having a use case, you're really betting on the future emotions of other people, right? And I do. That's why I'm really long crypto in general, is because I think a lot of people are suffering very much because of the problems of the financial system, and this is sort of a way to get out of that era. And yeah, so in 2000, so now we have kind of a period between 2013, 2017. Also, something that's a really big narrative is the halving. I'm not really exactly sure on that, but people, I think it's because as miners get less rewards on their block size when they mine them, it does some sort of 4-year narrative. And when you really do look out, like you kind of look out at the larger price times, you do have these periods where you have 2009 to 2013, 2013 to 2017, 2017 to 2020. And now we're kind of in a certain cycle too. So the question is, will it continue? And I think that I'm kind of bullish on it, and I'm excited to see it continue, just because this game is so much fun. Okay, but anyways, we had 2015. There's the block size wars, and let me see. Actually, this is the chart we're going through. Okay, so we go zoom into this kind of 2013, 2017 range. This is really where I like to use the fibs a lot too. So you have this kind of we have this kind of top of the range that we clear at $255. And then we have a new range that's created. And sometimes I like to use the fibs to see if you can predict the range. Sometimes it works, sometimes it doesn't. It works usually on the later one as you get more liquidity things in here. But we have this kind of 2013 to 2017 range. Here's your range high. Here's your sort of range low. Or I guess you could use this as a range low too. And if you do put it here and you look at the fibs, you know, we have this, as I said, like another parabolic auction. You go up, you have a sell-off that goes down like, I don't know, 80%, 60% too. So something also to plan for future cycles is like once you get that parabolic runoff, you really don't have a lot of time to sell off your bags before it starts to downtrend again. You know, and downtrend like 60 or 80%. I think in the future that will decrease. Maybe you'll only get like 30% corrections, but you know, when you're riding that first bullish impulse, you go there. And then we have this kind of between 2013 and 2017, you have this kind of nice bull markets, bear market. So it's like, you know, you go down, you have first rally, and then you kind of accumulate at this 1.136 fibs, and then you start to get this uptrend again. So like this, you know, really, if you get these kind of something that looks like this just kind of pops up like this, like a snail, like you want to get in, because that usually ends with a very, very big clearance. And we do eventually, you know, test the upper of this range, you reject this range, and then you clear up again, and then you back test, and then we start to really, really go. And that's something I've noticed also in the Bitcoin cycles is when you do clear out this range high, that's when you want to like go gig along. And that's when a lot of players actually go gig along. It's like when you can start to break this high, which was at $1,155. And then you repeat this cycle again, which is you just moon all the way up into the 2017 and 2020 range. So one of the most interesting things here in 2017 is actually the actual time when you get futures introduced to the market. So before 2017, it was mostly spot. But now that you have the advent of futures, it gives for the ability to borrow and then sell and then buy back your position, right? And this is probably, like, a lot of people think that's the reason why the price corrected, but I don't actually believe that's true. The thing is that it just always does this. Like, if you ever just have anything that looks like a giant bullish impush dildo, it just corrects, because eventually people just realize that you get exhaustion. Nobody wants to buy anymore, and then a sell-off happens, and you know, people start to realize the party's over, and then they start selling off. And the thing about shorts is that it actually does create future buyers in the price action, and with future buyers, you have a floor, which is really important for price stability in the markets. And the other thing too, I think what shorts do is they allow people to not have to sell off their positions, but rather they can hedge. And so that's an important thing that happened in the Bitcoin price history. Other things that happened in this cycle was the ICO, the initial coin offering mania. I wasn't really there, but this was like a lot of venture capital coming into the market and saying like, hey, we're just going to release this new coin or project. Most of it was vaporware, but like that was kind of the top cycle of that. And yeah, so we're going here. We have this downtrend. We have this really big, I don't know what that was. I think there was like some sort of collapse in the system. And this is, of course, the COVID one. But if you go back, sorry, that's kind of more of a messy lecture. I'm just talking about things. But, if you guys get some insights from it, then I'm happy too. So let's say you just put the fibs here at that first correction, or, I think this is a very decent area to put. That, of course, like this is sort of like that kind of final spring before we bounce all the way up into this auction. I'm putting the other fibs at the range high right here. And as you can see in 2013 and the 2009 to 2013, you have this impulsive parabolic uptrend, you have this very large sell-off. You have this kind of bottoming rally, which is very similar to kind of, I guess, the Terra Luna collapse, the FTX collapse. Then you have a very large rally. You hit that 618 Fibonacci. So I don't know whoever is in this market, they really do like the fibs because the market seems to really obey these Fibonacci patterns. Of course, you hit this rally, which was like a 200% rally, and then we keep going. We were about to go up again or not, and then COVID happened, and then we just kind of dumped all the way here in March 20, and then I think this price action was moved largely by Ethereum, right? And so what Ethereum can do is people buy Ethereum, they can stake Ethereum, and then they can borrow loans against that Ethereum. And it creates this whole new money supply, and that money supply is used to buy Bitcoin, which creates a whole new other cycle. But this cycle was from 2000. I mean, this was like almost three years of bear market. So I think when you compare it to this cycle here, like let's say we have here, I still think that we have some time to go. I think you have some time to accumulate. I think we might also clear out maybe these inefficiencies, and it just makes a little more sense, and probably during the recession. But I mean, another thing that's interesting too is like if you take this one and then this one here, you sort of get this 1.5 fib, that 28.53.2, and that forms a kind of a back test for this next auction here. So, but anyways, we've been in bear territory for a long time. Bear territory for a couple years, and then you had COVID, and then when COVID happened, basically the central banks just went, hey, we're gonna backstop the markets. We're gonna go pure QE, and wow, there's a lot more people than I thought. I wasn't looking at. I'm just looking at the chart right now. So, but that's something I think when I'm looking at the cycle too. It's like you're gonna have this range high, and I'll backtest this. You have this range low, and you have this very large bear market, and if you use the fibs like here to here, you can really see where accumulation is really good to have, and you could see where, and like the most important thing, like when for that bull market, it's really to break out that initial top peak. So in the future, if you're going to be looking for the future bull market of Bitcoin, it's going to be, I suppose, these two peaks that really clears. Because if it does, let's say if we do something like this, we go up, and then we have a recession, and then recession, and then something breaks in the financial system. So if something breaks in the so I tell my friends, like, hey, people are saying like QE is super bullish for the market, and I'm sort of on the position that QE is actually very bearish when they do it, because the reason that the central banks do quantitative easing is because they need to get credit flowing in the market. It means something is broken. Like if something breaks, then we need to repair that, and we need to make credit flow in the market, make money available, provide a floor for the market. And that means something really, really bad happened. So QE, everyone's looking for the Fed pivot, but right before the Fed pivot, or right during the Fed pivot, that means some sort of crisis happened in the market. And I think that with the recession, or whatever triggers the recession, or the interest rates happening, in which, as I was talking about with quantitative easing, is that when you bring interest rates really, really low, companies can keep rolling over the debt, and they can sustain themselves indefinitely. But when you start raising the hikes, then they actually have to settle that debt, and if there's not enough cash flow or collateral, they're forced to get margin called. And so that's when you're going to get these that's when I think you'll get that recession dump, and you might have this kind of pattern that goes like that, and then we're just gonna go kind of like up only, and then we'll see if we can clear this range up here at 63,000, and maybe kiss like 100K. I mean, that's a possibility too. But like going back to this 2017 to 20 range, we were there for 4 years. So that's something to be noteworthy of. And then eventually we do have, quantitative easing. You have sort of DeFi summer comes in where Ethereum and a lot of degenerate people borrow against their Ethereum and use that to, I mean, a lot of the reason that I think Bitcoin price goes up the way that it does has to do with leverage, right? Because if you can, let's say like we have actual $100 in cash, but I'm going to take a loan for $1,000. Now we have $1,100 in the pot right now. So it's like people are taking. I think a lot of this is actually loans and leverage, and you'll see that really start to play out in this cycle, where I think a large part of how this next cycle works, where it's like, let's say we start to clear this 2017 range. We have, of course, after this initial impulse, you have a 3-year bear market, and then you have another initial impulse, and then you have that really huge sell-off. But what's kind of different from the previous cycles is we have this really big dead cat bounce. And I think, so when I'm looking at kind of like the history of also derivatives in the market, let's say the actual initial impulse was probably here, right, like at this area, and then you have sort of a back testing of this range here, and then you have, let's say this is a kind of range high, and then up here you have deviation. So like, let's say here was probably caused by, so you had like a very excessive sell-off and a mean reversion. Let me see if I can bring up stock RSI, because that's really useful to look at on the weekly. Yeah, so you can see that kind of stock RSI, it's oversold, and then let's look at the Binance basis oscillator. Here's another really useful one too, is generally when this thing, it's easier to see on the daily. Right. You can see, the Binance basis oscillator is a representation of the difference between leverage and spot price. So whenever this thing is like in the red zone, we tend to nuke, right? Like eventually, because this is driven by leverage. So I think this price action here in 2020, February 20, was actually driven by leverage. You had that leverage get wiped out. And I think also going back to the weekly, I'm jumping around charts here a little bit. Oh. Right. So when we had this little bump down here, there's probably like a little bit of spot accumulation, but I think as leverage started to get into the system, you had this leverage thing here. This system was already really highly leveraged. When COVID happened, all that leverage got margin called. You retested the bottom, and then this also could be sort of like this really extensive mean reversion. And then that mean reversion hits all the way up here. And by mean reversion, I mean you have sort of an average price, like prices going on average, and then you have, let me clean up my chart a little bit. So let's say you just take a slope, and so you have things that are like outside the average, and then below the average, and outside the average, and below the average. And then eventually you get kind of like a ping, pong, boom. And that's also very similar to the FTX thing too, where it's like, when you have something that's sort of on an uptrend, but then you get this really large dislocation, as a bank collapse or Silicon Valley bank collapse. Those are actually really good opportunities to get in, especially the RSI. I think the stock RSI is really low, because in those situations there is a dislocation in the market, and a dislocation in the market means that somebody was probably forced to sell their position in order to gain like liquidity, or because they got liquidated. And then in order for the market to get back in line of stability, it's the bull trader that comes in and says, hey, I'm here to provide liquidity for the market. And those are kind of like the winning trades that you can really get within Bitcoin. It's like whenever there's like a disaster and the market needs to get back in line because it's really inefficient, that's kind of the time you're buying. And usually if you're more like an emotional trader and you just look at the news and you're thinking like Silicon Valley Bank and all the banking crisis is like, that's bearish, I should short or I should sell everything. And it's like, you should really be thinking about like, what does the market need? And the market always needs people to provide liquidity and balance to the market and provide support and stability. And I look at it as like, you have basically this kind of like this trend, and we're uptrend. And then you have these really large deviations from the trend, which, like these deviations can be caused by a lot of leveraged longs, and that's where shorts come in, and they cause these positions to get margin called, because there's really, in order for these moves to sustain, you need spot positions, you need people to continuously buy, and if those buyers get exhausted, then these longs are now, these longs get trapped, and then the shorts come in and they just liquidate them all. So, but some other things too. So like, we really, as I go on before, this move right here possibly was caused by, I've heard that it was caused by FTX leveraging a lot of things, but if we're looking back at the kind of price history, this is kind of like a range high. I also think of it as this is sort of the range that we've had for 2020 and 2021. You had this, and this is also Doge and meme season. So something I'm a little bit cautious right now too is, historically when you've had a lot of froth in the system, it tends to mean like people are getting kind of exhausted and they're just moving down the risk chain to lower liquidity. So like a lot of people made money on Bitcoin here, then they took profits on their Bitcoin and they started longing alts, and so that's when you get the kind of alt season. And then you get into alts that have no functional purpose other than being like memes, and so therefore like we are so far from fundamental or technical analysis, and then you have the market just kind of sells off, and we have a nuke. We have a very large nuke, and of course that correction was expected in 2011. Most of the people who got into Bitcoin, you probably started buying here. That was definitely, actually, I think I bought here, but, whatever. But, let's say if they tried to clear this range, this can also be seen as a mean reversion. So from what I've heard, in 2021, you've also had a really large tether print come up here. And so let's say you break down below the range, then you reclaim this range, you backtest the range, it holds, and then you get this kind of nice rally all the way up to here. You take out the shorts from here, and then we nuke. And so the basic price actions that we've had is that this was a very big season for Solana, Luna, and AVAX. That's where they went literally 200x. You've had basically the tech sell-offs happened here in November, and that was also when the Fed was getting very bearish and said they were going to do quantitative easing. Then we had the tech sell-offs in 2021, which is the beginning of the bear market. You had two floors, which was February 22, where we had I think it was the Ukraine war, and then you also had some pretty brutal bottoms. And then of course here we had Lunaterra collapse, and we had FTX collapse. So what I want to go like one last point on the thing of leverage is that with FTX, because they were the primary market maker in 2021, they borrowed a lot, like billions of dollars of Tether, and then they use that to pump the price. So I think I've heard people say that we probably should have just started bleeding down, but and then it also could have been a short squeeze too, because people were really bearish here. Like they say okay, the bull market's over, we're gonna sell everything. So I think you get a combination of FTX market makers providing a tether floor, and then squeezing the shorts, and then you could say this is a short squeeze slash, and eventually the shorts also close out here. And then you had a dead cat bounce, and then we go all the way up here. And eventually, this was also when 3x capitals, or 3 triangle, or 3 arrows capitals was very long. 2, they were very giga long on Bitcoin. They were expecting for something like this. And they were very over leveraged, and they eventually got margin called right here. And a lot of people got, this range was also very important because, once we broke this range, like around here at May 22nd with the Lunaterra collapse, all these longs that were holding up the price eventually got liquidated. And this market basically post 2021, like there hasn't been any really big volume. So we could say that like there hasn't been like people spot accumulating in a significant amount to keep pushing the price up. And I think that's also a cause for concern to say that, you know, even if you start from here and here, that's like 700 days. And that could also possibly give us another, like if you just look at historically, like another few 300 days, like another year basically, where we could stay in this range and accumulate and wait for larger players to come in and support the price. But this price action, you know, you had shorts, large amount of short Bitcoin open interest and FTX tether print, boom, takes it up, and then you had we had that kind of like correction from this large amount of leverage from FTX. And also, you know, when you do get a lot of leverage and like a dead cat bounce like this, and you also fail to clear out the previous high, like this is a time when people like, you got to be shorting, you know, and that was the short trade here. Then we had a bear flag in the early 2021s, which accumulated, and of course in, you know, Do Kwon is going to take us to the moon. He's going to start a new bull run. And then eventually it was just a Ponzi scheme that he created because he was apparently shorting BTC and using it to pump Luna, and then selling off Luna right before everybody. And then we had this very, very brutal downtrend, you know, down only. And then now we have this kind of longer accumulation range or range, crypto range that we're testing out. So, you know, I mean, that FTX also, when you kind of compare this, where FTX made the borrow all the way to here within a year, like they got margin called and they got taken out of the game. And now we are where we're at we have Coinbase, BitMEX, and what's that other thing? And Binance still. And so there's always a few questions I think that are probably worth noting is we still have this very, very kind of large amount of resistance right here. We could, of course, pop above it, reject, and then that could be our downtrend all the way into the recession. And then that could be something like that, where we look for just holding a nice kind of comfy spot, and then we go clear out this top range, and then you get a whole new cycle in 24 or 25. That's kind of what I'm looking at just as a longer term plan. Could we go where we go from here? Maybe we could squeeze up higher, or maybe we could squeeze lower and then go up. It's hard to say. But in a market when there's no actual buyers or sellers, a lot of it's determined by leverage. So it's like if you have too many people, like this could also be a short squeeze too, where you had FTX collapse, traders came in, they provided liquidity to the market and protected the market, and then you squeeze out all these shorts, and then you know, we go all the way up to this range. Now maybe also something also to pay attention to is on Twitter, there's really kind of two narratives. There's like everything's over, you know, banks are collapsing, everything's dead, and then there's like new alt season, new all-time highs, right? And like that's just like the two main emotions of the market at any given time, and that's really represented in the leverage in the market, right? Like always saying for new all-time highs, breakout trades at the tops. Well, this was also another one too. Like we're gonna have an alt season at the tops. I don't know why people do this. I think it's because people think only in one direction and not in terms of ranges. But you know, if you do look at, you know, Bitcoin is like the future of money, Bitcoin's future of money, Bitcoin's future of money, Bitcoin's over, Bitcoin's over, Bitcoin's over. And that's not how I think it's a good idea to think about the market. I just like to think about the market in terms of, as a trader, where are the extremities, where is the market over leveraged in any particular direction and needs to get back to baseline. And you can just go from there. So that's a little bit more of a shorter lecture. I'm going to open up the floor for questions. I think I went all over the place, to be honest. But hopefully people got some insights into just like looking at the longer term Bitcoin charts. And there we go. So somebody asked a question. Anybody? You guys all listening? Did you enjoy it? Let me look for the chats. Okay, so JC says Binance been giga long this whole rise, ain't they? Let me go check. I think so one thing I'm looking at that I think is interesting is the relationship of BitMEX and all the other exchanges, because Tether runs through Bitfinex, and exchanges have to have a certain amount of inventory of Bitcoin for buying and selling, and also to create a floor of the price. Because as if anyone paid attention to my last lecture too, if you're a market maker, you don't want the price to go to zero, right? Like your job as a market maker is just price stability. Same in the stock market too. It's like if the price can be stable between like even a dollar range, you make like 3 cents on every sell. But like if you make 30,000 sales, that's like $90,000 or something like that, right? So BitMEX, I still think that they're a giant Ponzi offshore scheme, but I don't know. I've seen the JC. I've seen the BSUD decrease. I've seen coin. USDC coin decrease, but US Tether has been increasing too. And the other thing that Tether does is it acts as a floor, so they can absorb sell-offs and they can absorb short positions, and then they create a stable range, right? Because unless you have an actual collapse, or like unless someone's actually forced to sell, like you have FTX who's forced to dump all the things in the market, then you can provide liquidity because as a market maker, you provide liquidity because that nobody can push the price down. And the same with like longs, right? Like and everybody calling for alt season is if there's no one actually buying or taking a bid, then you as a market maker can just come in with a bunch of shorts and nobody's going to stop you, right? Like who's going to put like $1 billion buy order at the top, to push out these market makers? Nobody's going to do that. So that's sort of like how I'm looking at the range and things like that in terms of price action, and why we also always mean revert too is because at some point either buyers or sellers are going to get exhausted, and when buyers and sellers are going to get exhausted, the market makers who provide the liquidity, meaning they have the whole inventory of Bitcoin and they have the whole inventory of Tether, they will pump and dump it at those extremities when they know you don't have enough retail, you don't have enough whales, you don't have enough institutions buying or selling at those areas. So I don't know if that answers your question, but I think one thing I've been trying to pay attention to more is on Tether futures data, because it's similar to wallets. Like when coins are going to the exchange, you don't really know what they're going to do for it. They might have it for inventory. So this new coin called SUI, SU is a good example too, where like 4% was allocated to market makers, and now they're holding a bunch of SU inventory. And like, what should they do? Should they buy it or should they sell it or they should hedge? We don't really know. And that's sort of just how the markets are working, right? It's like in this kind of bearish market too, is when you don't really have a lot of buyers or sellers, it's just going to be hedging and unhedging, right? And so like if the price is kind of stable, or we're fearful of a bank crisis, we're going to short to protect our spot inventory. But if the spot inventory, if there's no downward pressure, then holding these short hedges is like really risky, and so we close them off. And then longs sense that, like people who are long, they sense that, and then we kind of rally. And then when you have a bunch of people who are like, yeah, new alt season, new all-time highs, like new bull market, they open a bunch of leverage longs. And then, the market makers come in, they're saying like, well, no one's actually buying spot here, so we can afford to like dump, what is it, like 1,000 Bitcoins onto the market because nobody can stop it. And that's something I'm also taking as a philosophy for people to think about in trading, is like when you have like, if nobody can stop the price moving in any particular direction, then that's the time when market makers come in. And when the market makers are coming in to absorb or reverse the price, that's the time when you go with the market makers, right? Because that's like that's the kind of risk-free trade. I know it sounds kind of weird. I mean, like all trades are risky, but because there's no buyers, and then you have the market makers who are now willing to provide liquidity and create those walls, like these 600 BTC walls you see on Trading Light. Those are the entries that you actually want to take in the reversal. Like, never really go against the market makers, because market makers are much more strategic. They're not going to get in the way of a trend. Like, if something's going to go up 1,000%, or like Pepe, they're not going to come in and like their only job is to say like provide liquidity, and they're not going to actually provide a lot of liquidity or like sell side liquidity if the thing is just raging upwards with like massive amount of people bidding. Because if a market maker is going to be caught off sides, and they're going to lose a lot of money, so they withdraw until the market gets exhausted. They come back in, and then they reverse the price action. So I don't know if that made a lot of sense, but that's also how I'm looking at the major charts. Okay, any last questions? I think I'll hold on for like 2 or 3 minutes, and then I'm gonna eat lunch. But yeah, I mean, I think everyone, you'll learn a lot if you go back to the previous cycles, and just even with like simple fibs or just simple like price action, you have your range high, you have your range low, you have this, we just go through the range until we break the range, and then we keep going up, right? And that pattern has been very consistent. I'm pretty sure other traders are and very, very big positional players like whales will see that too. And that's my initial guess is going to be the same thing's going to play out. Maybe it could take a little bit longer, shorter. We don't really know. But I think we're going to get that recession crash. Then the Federal Reserve has to go in, because the American economy is a zero interest rate economy. Like, we survive by just credit. We survive by rolling over debt and borrowing more in order to get productivity. And it sucks for everybody, but that's just how the banking system works. And if history replays, then we could see something like that, and just survive until then, right? Like, we survive the bear market until that happens. Okay, I'm gonna end the stream.